Cisco Systems. Now, here's a good example. This is a stock I pretty much just missed the whole thing. And I remember back in 1990, when this stock was running up, I was looking at it probably sometime in 91, that it had base after base after base after base. And one of the things I was thinking is, I don't want to get in this thing because it comes out of a base in March of 91, and there's another one in June of 91, and then there's another one in September of 91. And I'm not impressed with this because it's just doing so many bases and bases and bases. But it kept doing that for a long time. And that was where the mistake was made. But I would have probably not done as well had I really gotten in there with it, because I'd be in it and then 6 weeks later it's starting another base. So after a while I get tired of that and there's something else that's performing a little bit better. I do think at the time that there was something else, and I don't even remember what it was because that's 20 years ago. But if I just see one base after another, it isn't going to be as attractive as the one that's moving up at a more steady clip. But this was an exception to the whole thing, and you would have to sit through all these bases. You needed to understand that this company has got something that's really unique, and they're superior in it, and they dominate, and it's going to just keep chugging along at a certain rate of growth, 35% or whatever it was, year after year. So I missed this. We did buy it once, I think, but basically didn't handle it right. Livermore had this rule that he had developed, that if you hit bottom in a correction, you rally up, and it rolls over and breaks the new low ground, when it comes back through that low by 3 points, and he's talking about a $30 stock, say the first bottom was at 30 and it breaks and goes to 27, now it comes back from 30 and goes to 33, 3 points above that prior low, that establishes a new buy point. I call that the Livermore rule, and it works pretty sound. You had your big shakeout, and now you come back through the other way, and you're setting a new target, and that is a buy point, and I've used that several times. You also see you get people shorting when it rolls over and breaks the new low ground. That's not the time to short. You're too late and too obvious. In other words, everybody can see the stock's breaking down and all, and that's not the time to short. So that adds to when you're buying it after it's come back through that low by 3 points. You've got the people in there short as well as people that know better and are buying the stock at that point. That's what causes that to really move. Some people get trapped in that kind of situation. So I've used that rule several times. You probably have 7 or 8, maybe 9 different bases. You got a double bottom, a flat base, a high tight flag, a cup without a handle, a cup with a handle, and you have several buy points that you can buy coming off that bottom with that reversal and the 3-point thing, or you can buy coming out of the handle, or you can buy after you've gone up and you pull back to a 10-week line and get some support there. So you have a list of all the type of bases you'd buy and all the positions you'd buy in, and any of these stocks you can see from these charts that there are far more than just one buy point. So if you miss the first one, there'll be a second one somewhere along the line, and there'll be a pullback to the 10-week line or something. So you can get into a company if you understand what are all these buy points. You want to buy at a time when it is a specific buy point, not, oh, I like this stock and just buy me some. Because maybe you're extended or you're in the wrong position and he's going to correct on you right after that. And you say, well, that's okay because I'm a long-term investor. Well, yeah, you do that, and sooner or later you sit with one you shouldn't be sitting with, and now you're down 40, 50%. So you want to eliminate all those and learn to buy at correct buy points. And there are several, and you need to probably maybe make a little list of them and an example of what's the difference between all these buy points, because there's not just 3 or 4, there are a whole bunch. I think you just know from studying some past charts of big winners that if it's a winner, it's going to build a lot of bases and give you a lot of other buy points. They'll pull back to the 10-week line several times. Let's just take a quick look at the Cisco on this one page. I can see the one buy point. There's a second one, it pulls back to a 10-week line. There's a third one that has another base in March of 91. Then you get another pullback to a 10-week line. So there's a fourth one. There's another base in September of 91. So that's a fifth. You get another base, it's a sixth, and you get some pullbacks to the 10-week line 2 or 3 times. So you're up probably to 9 by now. And a winner is probably going to build 6, 8, 10, 12, different buy points. So if you miss the first one, if you track it long enough, sooner or later you'll get another buy point. The first stage base works most of the time. The second stage works, but sometimes the third stage is too obvious, and it reverses and corrects and then turns around and builds a new base, and they'll start to work. If it is a truly great growth stock, it may go on a lot further than you think without having one of those undercuts. For example, on Cisco, I guess the time that it really threw somebody out was in September 93. It broke out of a prior base and comes down and undercuts very sharply. But I don't know, that was really a late stage. First stage, second, third, fourth, fifth, sixth. I mean, it just kept going for a long time. Sometimes they can correct and undercut a prior base just a little bit and then start all over again. That starts your base count over again. So you've got to understand that situation. And so at what point do you start counting, now here's a new first base? So there are these little skill things that you've got to learn so that you're reading the map to know exactly what's going on. Did it undercut a prior base? And therefore, if you build a new one, that's going to be a first base. So that's a little thing you're going to run into every once in a while. So it either is or isn't, and you've got to be able to understand what makes it one thing or the other so that you know what you're dealing with. You don't want to be buying on a four-stage base. Now, you might get away with it maybe 1 out of 3 times, but the odds are very much against you there. And a fifth stage, probably the odds are much worse. So you're playing percentages all the time. If a first or second stage base, you don't have to worry about it so much as long as your earnings are there and the sales are there and everything fits and the market's okay. Incidentally, a lot of people will sell short when the stock rolls over and breaks to new low ground. You don't short that way. That's too late. And usually it'll turn and run back in one time. So you've got to short when it breaks down badly, rallies up to its 10-week line or above it, and then comes back through the 10-week line with the volume picking up before it makes a new low. But if you're shorting once it's a new low, it's too obvious, and they'll run it in normally. I wouldn't waste too much time trying to short sell. I think once I did well with it, but that was years ago. I don't try to get cute and do all that stuff. I'm just looking for what's the best thing to buy at the right time.